Just stand here. Yeah. All right. Good. My name is Andrew Stotts, and we are going to talk about a question that I've been having. But first, I got to get my microphone set up. Hold on. There it is. Now you can hear me. So I've got a question, and that is, what's going to happen with the U.S. stock market? Is it going to crash? Is it going to rise? This is an important question because no matter where you are, where you're living, the reality is that if the U.S. stock market crashes, it's going to affect your market. So I wanted to talk a little bit about it. We're going to do a little blog post after this, but I thought I would just go over some of the main things. So the first thing is that it seems that everyone expects the U.S. market to crash eventually. But they're still riding this bubble up. So this bubble is happening in the U.S. market despite a large fall in earnings for nearly all companies. It's important to note that actually a large number of companies in the U.S. stock market, a large number of these companies, profits are being generated. Almost 20% of profits are being generated by one sector. Do you know what sector it is? What sector? Let's see. So I'm just going to write this down. The U.S. stock market eventually crash. So the answer to that question is the tech sector. So we know that the tech sector is driving a lot of what's happening in the U.S. market. But of course, there's other things going on. Now, with the Fed trying to keep interest rates super low, what does that mean? Well, you don't get any benefit from putting your money in the bank because you're not going to get any interest. And even putting your money into bonds, you're going to get a very low amount of interest. And of course, if bond prices are basically sky high, we've been through a long-term bond rally with now bond yields being down so low. There's not a lot that you're going to gain from buying bonds. Now, one type of bond that is interesting, I talk about it in one of my courses, how to start building your wealth investing in the stock market, is the TIPS government bonds that can protect you against oncoming inflation. So now let's look at some of the issues, right? The bears in the market may be overlooking three factors. Factor number one is the possibility of a second wave of infections. So I meant to say the bulls in the market could be overlooking the fact that we've got a second wave coming. And what's going to mean? I mean, I was just out the other night and I went out to dinner with my friend. And there's a little place called After You next to the dinner location. And the last time we went there a couple of weeks ago, it was open. I was like, wow, interesting that it's open even, as COVID is, here in Thailand. But then 2 nights ago when I went to it, it was closed. No desserts, no nothing. And it's a dessert place. It's an after dinner place. So that was already an indication of a second wave. Now, some people, when they say second wave, they're really talking about COVID, but I would say a second wave of economic disaster. So that's number one. The second thing is that many companies during economic downturns are likely to cut their dividends. They're going to stop stock buybacks and they're going to reduce their capex. And this is naturally going to slow down the economy. Now, this reminds me of one of the best books I've ever read as an analyst. See if I can find it. Where is that book? The book's called Ahead of the Curve. And that particular book talks about the idea that everything starts with the consumer. So I just mentioned about capex and companies spending, but without consumer demand, there's no need for capex. So remember that factories are secondary to demand. Factories do not create demand. The demand is created at the consumer level, and then that demand is put onto the factories. Now, the third issue is unemployment. Right now, unemployment as of July 2nd, the U.S. Labor Department saw about 18 million people submitting unemployment claims. I've seen estimates as high as 20%, 25% of unemployment in the U.S. There's lots of different ways to slice these numbers, but there's no arguing that there's a lot of people that are out of work. So where is the demand? And think about it. Mortgage defaults, rental defaults, credit card defaults. This is the reason why the banking sector has been falling, because it's going to fall on them. So it seems logical to believe that, a V-shaped recovery is probably unlikely. Now, of course, we've had a V-shaped recovery in the market, but that doesn't mean that we're going to have a V-shaped recovery in the economy. Now, another one is, speaking of rentals, imagine all the college towns around America that are going to be desolate, ghost towns, rather than thriving. Every fall, millions of young people go to these college towns. So what do you think the landlords are going to have to do in this case? Keep in mind, many of these college towns are in cold areas. They still have to heat the houses. They still have to spend. Do you think these landlords can pay the mortgages? No. So there's a real risk that this unemployment turns into something really scary. Now, here's where people could be wrong about the market crashing. First thing is, the Federal Reserve is doing everything it can to prop up the market. We've already seen them set up special purpose vehicles as a sneaky way of getting around the issue of the Fed not being allowed to invest in individual stocks and bonds. So the Fed, by its charter, is not allowed to do that. But if they could set up another company and they invested in that one company, and then that company invested in bonds or stock, then it's okay. And so they set that up and they asked BlackRock to manage it. And so that's how they're getting around it. And that basically means that they've been able to be buying government, they've been able to be buying company bonds. Now, it's important to remember that the stock market is tiny compared to the bond market. In fact, compared to the debt market. Where do companies get their money? They borrow from banks and they issue bonds. These markets are massive. So what the Fed's trying to do in this case is they're trying to prevent the price of high yield bonds to basically collapse and yields to rise. In the 2008 economic crisis, we saw that the spread between high yielding corporate bonds, in other words, high risk corporate bonds, that spread between that and the US Treasury went up to almost 20%. This was the market pricing the risk. But now, in this case, the Fed announced its bond buying and its high yield bond buying situation. They announced that. And what happened was that the spread between high yield bonds, instead of being 20% above treasuries, it only went to about 8%. And then it started to come down, or maybe 10%. So this is the Fed coming in and trying to prevent the bond markets from collapsing. So, maybe we just have a continued rise because the Fed can buy. And speaking of that, what is the Fed chairman saying? He's basically saying he's going to do whatever it takes. Now, if you had a car and you wanted to sell it, and somebody said, I'll buy any car of that year and of that make, absolutely guaranteed. So you have a guaranteed buyer. How do you feel? Basically, it means that you are guaranteed that the price is not going to go down below a certain point. How exciting is that? It's like you've reduced your risk. It's like the Fed took away all the risk of investors in the market, as long as they say and they do whatever it takes. Now, the man or woman who said that they'll buy that car don't actually have to buy the car. They just have to say that they'll buy the car in order to prevent the price of that car from collapsing. Eventually, people who have that car will try to sell that car. And if that person doesn't fulfill what they've said, then you've got a problem. And then the price of that car could collapse. Now, I also want to talk about the idea of, can the Fed buy stocks? So far, the Fed has not really bought stocks. So what's been happening in the stock market is two things. Why did the stock market go up if the Fed is not buying stocks? First reason why is because if the Fed's not buying stocks, but if they're pumping money into the economy, then that money could be used to buy stocks. The second reason is that just like this buyer of this particular car, if you know there's a buyer out there, then the market's not going to come down. So not only has the Fed affected the bond market through actual buying, but they've also affected the stock market by talking about how they're going to do whatever it takes. So there's people out there that are expecting that the Fed could come in and start to buy stocks. Now, it seems kind of unlikely, but keep in mind that other foreign central banks, like the Bank of Japan or the Swiss National Bank, have already been buying stocks. In fact, I was just looking at something here, and basically what I saw was that one shocking statistic is that the Bank of Japan owns more than 70% of Japan's equity market ETFs. That's crazy. That means that the central bank in Japan is a major buyer of stocks. So don't think that it couldn't happen in the US. Also, the Swiss National Bank, as of first quarter of 2020, owns about $100 billion worth of stocks. Now, if you believe that markets are going up, consider this. The Fed's actions don't always achieve the desired outcome. So despite this massive stimulus and injection, many small and medium-sized businesses just won't be able to survive. And the result is many workers will be laid off. There'll be delays in all kinds of investment plans. And also, I would argue that we are running into a situation where the gap between the price of the stock market and the earnings of the stock market have widened so massively that the risk is extremely high. And I want to bring up a graphic here. So just give me a second. I'm going to bring this thing up and show this particular one. This gap right there, and we think about it, there's a huge risk that the US stock market will eventually fall. So what do you think? This is a tough challenge. And if you are managing your own money or other people's money, or you're thinking about your business, you got to think about this very carefully. Now, in conclusion, my feeling is that we will see a collapse in the US market. And if we don't see a collapse in the US market, we may see a collapse in the US dollar. And that's a topic for another day. But what I would say is that if you believe that the US market is going to crash, you have a few choices. Choice number one, take your money out of the US market and hold it in cash. Choice number two, take your money out of the US market and hold it in bonds. And choice number three, take your money out of the market and hold it in some other type of asset that you think could hold its value. That asset could be gold. That asset could be land. That asset could be a house, something that you think will not collapse. Those are some ways that you could protect your assets if you are right in believing that the US market is going to fall. If you've got any questions or any ideas on that, feel free to share in the comments. And